There's a single number on your federal tax return worth $16,100, and most people claim it in about 4 seconds without ever checking whether the other option would have saved them more. For tax year 2026, the return you generally file in 2027, that number is the standard deduction for a single filer. $16,100 of income, the federal tax system simply doesn't tax. But there's a second path, called itemizing, and for some people it's worth thousands of dollars more. Choose the smaller deduction, and you could pay more federal income tax than you had to. In the next few minutes, we'll settle it the only honest way, by running the actual numbers side by side. This is education, not tax advice, but by the end you'll know exactly how the choice works. Start with what a deduction actually does, because this is where the myths begin. A deduction does not cut your tax bill dollar for dollar. It lowers the slice of your income the government is allowed to tax, your taxable income. Picture your income as a stack. A deduction shaves an amount off the top of that stack before any tax rate ever touches it. So a larger deduction means a smaller taxable income, which means a smaller tax. Hold on to that distinction. A deduction reduces the income you're taxed on, not the tax itself. Because later it's the difference between saving a few $100s and only thinking you saved a few thousand. Every taxpayer picks how they take this reduction, and there are two ways to do it. The first way is the standard deduction. It's a flat amount the tax code lets you subtract, set by your filing status, and you don't have to prove a single expense to claim it. For tax year 2026, a single filer's standard deduction is $16,100. Married couples filing jointly get double that, $32,200. Most individual taxpayers can claim it, though the tax code carves out some exceptions. Its appeal is simple. You generally don't need to document Schedule A expenses to take the standard deduction. No line-by-line receipts, no records to keep for it. You subtract the flat number and move on. For many filers, that's the end of the story, and often it's the right call. But that holds for many people, not all. And the only way to know your case is to look at the alternative. The second way is to itemize. Instead of one flat number, you add up specific deductions the tax code allows and subtract the total. The big ones for most households are these: mortgage interest, the interest you pay on a qualified home loan; state and local taxes, often called SALT, your state income or sales tax plus property tax, added together, but only up to a cap set by law; gifts to qualified charities; and certain medical expenses, but only the part above 7.5% of your adjusted gross income. You list each one on a form called Schedule A, add them up, and that sum becomes your itemized deduction, which sets up the one question that decides everything. Is that sum bigger than the standard deduction you'd otherwise get without any paperwork? Let's put a real set of numbers on it. Meet a single filer. Assume $85,000 of adjusted gross income, that's income after certain adjustments, and assume all of it is ordinary income, with no tax credits or other taxes in this simplified example. This person owns a home, so they have real deductions to itemize: $14,500 of mortgage interest and $8,000 of eligible state and local taxes, comfortably under the cap. Add those, and their itemized total is $22,500. Now the comparison. On the standard path, they subtract $16,100, which leaves taxable income of $68,900. And running that through the 2026 single brackets, their federal income tax is $9,870. On the itemized path, they subtract $22,500 instead, leaving taxable income of $62,500. And their federal income tax is $8,462. Same person, same income, same year. The only thing that changed is which deduction they took. Itemizing left them owing $1,408 less. That's not a rounding error. And notice where it comes from. Their itemized deductions beat the standard by $6,400, and that $6,400 would have sat in their 22% bracket. 6,400 times 22% is exactly 1,408. So here's the rule that falls out of the math. If you're eligible for either method, the usual federal calculation is to compare your allowable itemized deductions against your standard deduction and use whichever is larger. Larger deduction, smaller taxable income, smaller tax. In our example, itemizing 1, but flip the facts. Say this person rented instead of owning, with almost nothing to itemize. Then the standard deductions, 16,100, would win easily, and itemizing would be the wrong move. Neither path is better in the abstract. The better one is simply whichever number is bigger for you in your tax year with your actual expenses. That part of the decision is arithmetic, not opinion. If itemizing can win, why do so many people take the standard deduction anyway? Because the standard deduction is a high bar to clear. When the law roughly doubled it several years ago, that flat amount became larger than a lot of people's itemizable expenses added together. Many taxpayers use the standard deduction simply because their allowable itemized expenses don't add up to more than it. So there's nothing to gain from the extra work. That's not laziness. It's the math landing on the standard side. The filers most likely to come out ahead by itemizing tend to be homeowners with sizable mortgage interest and state taxes, or someone with an unusually large deductible expense in a given year. A big medical bill, a major charitable gift. The way to know which camp you're in is to add up your itemized deductions and compare. The same move we just made. Now, the most expensive misunderstanding in this whole topic, and the reason we were careful about what a deduction does. A deduction is not a tax credit, and mixing up the two costs people real money. Watch. A $1,000 deduction lowers your taxable income by $1,000. At a 22% marginal rate, that saves you about $220 of tax. The 1,000 times 22%. A $1,000 tax credit is a different animal. A credit comes off your tax bill directly, so it can cut what you owe by as much as the full $1,000, subject to that credit's own rules. Same headline number, $1,000. But the credit can be worth several times more because it attacks the tax itself, while the deduction only shrinks the income the tax is calculated on. So when someone tells you a deduction saves you its full face value, they've quietly turned a deduction into a credit in their head. That's not how a deduction works. One honest footnote. Because the tax code loves exceptions, the standard versus itemized choice decides how you handle Schedule A. But a few deductions live outside that choice entirely. For example, starting in tax year 2026, people who take the standard deduction may also deduct up to $1,000 of certain cash gifts to charity, $2,000 for a married couple filing jointly, on top of the standard amount. Rules like that shift with the tax year and with new laws, which is exactly why you don't run this from memory. You run it on the current year's rules, or with someone whose job is to know them. So let's lock it in. 1. A deduction lowers the income you're taxed on, not your tax bill directly. 2. You get that reduction one of two ways: the flat standard deduction, or itemizing your specific expenses on Schedule A. 3. If you can use either, the usual move is to compare the two and take the larger, because the bigger deduction means the smaller tax. And 4. A deduction is not a credit. A deduction generally saves tax at the rate that would have applied to those dollars, while a credit can come straight off the tax you owe. These figures use the 2026 federal rules for a single filer, straight from the IRS, a worked illustration, not a recommendation for your situation. Whether itemizing beats the standard depends on your own deductions, your filing status, and the tax year. So check your own numbers, or ask a professional who can. This is education, not tax advice. But the choice itself isn't a mystery. It's two numbers, and you take the bigger one. If seeing the math laid out made this finally click subscribe, this channel turns the money decisions everyone feels, but nobody explains into numbers you can actually see.